Good afternoon, good evening, and good morning, everybody. Thank you so much for joining our East Asian Institute Distinguished Public Lecture on a topic which is very close to my heart. 25 years after the Asia financial crisis, what have we learned? And I'm delighted to have Dr. Hoe Ee Khor, who I will introduce formally in a moment, to be the speaker, because he's the man with great experience in the topic. As many of you know, the Asia financial crisis 25 years ago was a dramatic, or should I say, a traumatic time for East Asia, for countries that had been very successful in development, and basically were caught up in a sudden stop of capital flows, which through contagions, it started in Thailand, through contagions went to Indonesia, Malaysia, Korea, but really the region, and in the end the rest of the world. So really a traumatic experience, but also a galvanizing experience to some extent, because a lot of reforms came out during the crisis that had to happen to fight a crisis, but later on a whole range of reforms in the international financial architecture, in the thinking about capital flows, the thinking about exchange rate, which in the end brought Asia on, in my view, on a very sustainable and fast-track growth after the financial crisis. Of course, that is still debated as we speak. It is still debated, among others. In that debate is our speaker of the day, Dr. Hoe Ee Khor. He oversees the macroeconomic and financial surveillance work of AMRO, the ASEAN +3 Macroeconomic Research Office, which is, of course, the office that serves the Chiang Mai Initiative multilateralization arrangement of a regional exchange rate, a reserve arrangement that I'm sure Dr. Hoe Ee will refer to in his speech. AMRO comprises of 10 member countries of ASEAN and China, including Hong Kong and Japan and South Korea. Dr. Hoe Ee Khor has a very distinguished career. He has been in the region and beyond for a very long time, and has a tremendous experience and tremendous service for civil service in Singapore and internationally. He started his career in the IMF, then came back to Singapore and was at the monetary authorities, where he was the assistant managing director of the monetary authorities from 2001 to 2009. He was then went back to the IMF and was the deputy director of the Asia and Pacific department at the International Monetary Fund until he joined AMRO. Dr. Khor worked on many countries. I looked through his publications list that I looked up, and he worked from countries such as Mexico, China. He and I worked on China together in the early 90s when China was full of reforms, and Malaysia and many other Asian countries. Dr. Khor holds his PhD from Princeton University. Delighted to have Dr. Hoe Ee Khor here. If you'd like to ask a question, please use the Q&A function. You can do that during the lecture, and I will moderate the question and answer session afterwards. Dr. Khor, the floor is yours.
Thank you, Bert. Like you, I think this Asian financial crisis is an event that is very close to my heart. I arrived in Singapore in 1996, actually, and was head of the economics department at that time when the crisis broke. And it's because of the Asian financial crisis that I ended up staying in Singapore for the next 12 years before I left for Abu Dhabi, and then went back to IMF, and then came back here as a chief economist for AMRO. So this particular lecture is very timely because we had just prepared this book here, From Trauma to Triumph, Rising from the Ashes of the Asian Financial Crisis. We had planned this book to celebrate the 10th anniversary of AMRO back in 2019 or even 2018. And then because of COVID, we got, the whole schedule was delayed, and but it came out at the end of last year. just in time for the celebration of our 10th anniversary in December. But we had a soft launch then. And then in May, we had the hard copy that came out. So as it turns out, it was, it helps to commemorate the 25th anniversary of the Asian financial crisis. And the reason we did that is because it's because of the Asian financial crisis that AMRO was established. So we want to commemorate this our existence by putting up a book to basically for posterity, what a record of for posterity, what happened during the Asian financial crisis and what we have learned thus far. So the book has 3 parts. I'll just talk briefly about the book. The first part is basically a series of interviews with policymakers who were present during the crisis, And the second part is a series of studies by eminent academics for each of the countries. And then the third part is talking about financial cooperation, and the developments of the regional financial institutions. So the first part is what is different, I guess, distinguish the book from others on the Asian financial crisis, because when you read that part, you'll find out that despite the fact that it's been 25 years, the memories are still very vivid, and many of the participants at that time, will recall with great detail what happened then. So this helps to bring the crisis back to life again, in some sense, and I think it's a good way, to basically record what happened for posterity, because as time passes, I think the newer generation has very little memories of what happened. In fact, in AMRO, most of my younger colleagues, they basically, don't know very much about the crisis itself. But for those of us who lived through it, it's a very traumatic experience, and I think most of us still remember what happened. So that's for background. Okay, so this is basically an outline of the presentation. I'll first start with the causes of the crisis and the lessons that came out of it. And then I'll move on to talk about the changes in the policy and regulatory framework at the individual country level, and then at the national and international level. And I'll end with maybe a short, brief discussion of the new risks and challenges facing the region, and what directions it implies in terms of policy changes. So many of you remember, all these headlines back in 1997 or 1998. The IMF at that time was stand for I am fired, or so it was a very traumatic period for countries that were hit by the crisis. As you can see, the headlines are quite dramatic. Thai stocks stumbled as baht slides the weakest in a decade, or the floating of the rupiah, and how the President Suharto was, had to resign. And in Korea, I think the memory remains very strong until several years ago. Whenever you visit Korea, they refer this as the IMF crisis. So it was a very difficult time for most of the region. A lot of people, lost their savings, and there were even people who committed suicide. Businesses went bust, and governments got overthrown. So, and until today, I think the IMF stigma is still there. It's slowly fading away. I think a big breakthrough took place in 2018 when the IMF held its annual meeting in Bali. It was just before that the IMF MD wanted to visit Jakarta, and immediately there were demonstrations in the street. So they had to give an issue and a press release that the IMF is not coming to lend money to Indonesia, but to have some discussion. So, but they managed to host the meeting in 2018, and I thought there was a breakthrough in terms of relation between Indonesia and the IMF. But because of the stigma, that was the reason why AMRO and was set up also. Okay, so what was the cause of the crisis? As you can see from these charts here, the region had relatively strong fundamentals leading up to the crisis. If you look at growth, they were averaging between 7.5% to 10%, averaging about 8-9%. Very strong growth. And the World Bank had came out with a new report called the East Asian Miracle, celebrating the success of the region. And you look at consumer prices, the average, they are low to moderate. This line here is for the Philippines, and they were trending downwards. So inflation was relatively low and moderate. And if you look at current account, they range between 4 to 8%. The highest being for the Thailand, which is around 8%. But for the rest of the economies in the region, it was around 4%. So it's relatively moderate. And if you look at this is the chart on the debt to GDP ratio. But if you look at the fiscal balance, they're mostly in surplus, a small surplus. So when the shock happened, it was a real shock to the whole region. Everybody was celebrating the success of the region, and all of a sudden, there this massive shock. And most people are very bitter, and and of course, the shock took place because of speculative attack, as we all know, on the Thai baht. So let me move on. Okay. So what are the causes of this Asian financial crisis? These are the commonly cited causes of the crisis: excessive lending and borrowing. So that's part of the original same problem, that emerging markets are unable to borrow in their own currency, and so they're borrowing in foreign currency. And because at that, the external loans tend to be cheaper, a lot of corporates borrow in external loan. And at that time also, their currency tends to be pegged to the US dollar, or relatively in one form or another tight. So that results, there's sort of a moral hazard issue, because the corporate assume that the exchange rate will remain relatively stable, and so for them, borrowing externally makes a lot of sense because it's much cheaper. But that leads to a double mismatch problem, where you have a currency mismatch between the currency of the loan and the revenue that they derive from the investment. And there's also a maturity mismatch because a lot of these loans were used for projects which have much longer gestation period. So that leads to the double mismatch, which has been identified as one of the causes of the crisis. The other cause is that the policy and regulatory framework in the region had become outdated, and I will get into that a bit later. Most of them, as I mentioned, had pegged exchange rate, and regulatory framework was relatively simple. They are basically compliance based, and the only ratio that was at that time was the capital adequacy ratio, which was set at relatively low level at that time. And then there were, of course, the massive speculative attacks by macro hedge funds. We know about the famous Soros hedge funds, and they were, going around looking for vulnerable currencies, and Thailand seems to stand out at that time. They were already having financial issues even before that. Some of the finance company and property company, were running the problem. So it became a target for the hedge funds. And along with that, of course, once the hedge funds begins to attack and the currency begins to weaken, you have the herding behavior by other investors, who take the weakness of the currency as a sign that the currency is weak. So that leads to this herding behavior where which is what actually the macro hedge fund was trying to do, to precipitate a massive run on the currency. And a lot of people blame this crisis also on poor corporate governance, particularly corruption, cronyism, and nepotism. But we know that these factors have been around for a long time, even leading up to the crisis. But the crisis sort of revealed many of these issues, and that's been blamed also for the crisis. I guess one can argue that it's because of cronyism which leads to excessive borrowing by the corporate sector, and many of the projects that were financed were also had poor returns and were unable to service the loan. So there's some aspect of this poor corporate governance that I think is quite valid. And finally, and in my view, the systemic cause of this crisis was the breakdown of the Bretton Woods system in 1991, which led to financial liberalization and the globalization of finance. Let me start with the last one, which is the globalization, the breakdown of the Bretton Woods system. If you look at the chart on the left, you can see that capital inflows into the region, right, back in the 70s was relatively quite small, but it begins to spike up, leading up to the Asian financial crisis, and then there was a massive reversal, when the crisis hit. And this was like over $100 billion of flows, that reverse itself. And of course, that's a big shock to the system. And it's not surprising that it led to the currency crash and stock market collapse, and give rise to a run on the currency. Similarly, on the right side, you see a similar profile. The massive inflow into Korea leading up to the currency and the reversal. And so this happened because of the liberalization of capital markets and the financial system back in the 70s. And it's been sort of building up over time, leading up to the crisis. If you look at the charts on the right side, right, you see that the frequency of crises, increases over time, right? From the 1970s, when the Bretton Woods broke down, you can see that the crisis became more and more frequent until it peaked around the Asian financial crisis, and since then it's sort of been a decline. Until the global financial crisis, which is this bar here. Since then, there have been outbreaks, mostly currency crisis. And on the left-hand side, these are the major crises along the way. The oil crisis back in the 70s, leading up to the Latin American crisis. The oil crisis, interesting because it reflects the easy monetary policy, partly the expansionary policy in the US, and that led to high oil prices and the need to recycle the petrodollars, as they call it, which were deposited in New York and London. So that was the reason for the build-up in the Latin American crisis, because a lot of this excess dollars were recycled into Latin America, which came to a head back in 1982, and led to the current account crisis, basically, in many of these Latin American countries. And then we have the tequila crisis in 1994, leading up to the Asian financial crisis. So there's a a series of crises that took place after the breakdown of the Bretton Woods system, which was replaced by a floating exchange rate system with the US dollar as the dominant currency and the numeraire, basically, against which most other currencies float, right? And that was a shock or change in the international monetary system, which gave rise to a lot of unforeseen consequences. So as you can see, the impact of the crisis on the region was pretty severe. The currencies depreciated very sharply. The red line here is Indonesia, and it fell by almost 80% of its value. And the other currencies depreciated by almost 40%. So it was a very sharp devaluation. So you can imagine if they borrow in foreign currency, in US dollar in particularly, they will completely be insolvent because they cannot meet the liability, the obligation to service the debt. And the stock market also collapsed, as we can see, because the corporate, to the big balance sheet was damaged. And so many of them also, the stock market crashed, and took a while before they recover fully. And on the right hand side, you see the real GDP. The most severe one is Thailand and Indonesia. And Philippines was relatively unaffected because it just came out of a balance of payment crisis in the 80s. And so it didn't borrow as much as the other economies did leading up to the crisis. So as a result, it was relatively unscathed compared to the other economies in the region. But all the other economies took a big hit in terms of the GDP growth. And you can see from this chart, this is the trend output line. Because of the crash, many of them, fell sharply. And although they recover, they never actually get back to trend, But what is important, and not only that, the growth rate also came down. It used to average 8.2% before the crisis, and it came down to about 5.6%. So that's about 2.5 percentage points lower than what it used to be before the crisis. So there was a cost to it's called the scarring effect, both in terms of the output level as well as the growth rate. And fortunately, of course, the region did manage to recover and grow relatively strongly, although much lower. One can argue that the 8.2% was not sustainable in any case, because it was based on borrowed money. And so the 5.6% turned out to be much more sustainable. But, as I will show later, it was due to a collapse in the investment. So this chart shows the credit to GDP gaps, and as you can see, most of the credit GDP gap was relatively low, and it was only Malaysia and Thailand. Thailand, GDP ratio was much higher, so it was really borrowing, heavily in order to, for all kinds of property projects in Thailand, particularly in Bangkok. And in the case of Malaysia, there was a sharp ramp up in borrowing leading up to the crisis because of many of the mega projects at that time. The spike up for Indonesia is due mostly to the collapse in the GDP, because as you can see, actually the credit GDP ratio was relatively low. But because of the collapse of the GDP and the exchange rate, there was a lot of foreign borrowing by the corporate, and that shows up as a spike in the debt GDP ratio. But you can see the collapse in investment, because of the crisis. It used to average around 40%, and it went down to about 25%. So there was a massive decline in the investment rate to GDP ratio. And of course, again, one can argue that, this was excessive in any case because it's based on, cheap money, and this was more sustainable level. But it does mean that, growth rate did come off very sharply, as you can see earlier. The growth rate, went from 8.5% to 5.6%. Yeah. So for each of the, I just go through very quickly, what happened in the crisis hit economy. Thailand being the first one, they suffered a very sharp, hit to the growth, and they recovered somewhat. But as you can see, the growth then was 4.9% as against 7.3% before the crisis, and it came down further after the global financial crisis, 3.7%. And most recently, the COVID period. So Thailand has been subject to a series of shocks, and this gap here basically reflects the scarring effect, from the crisis. You can see from this chart here on the right side that investment collapsed here to about just over 20% from a high of 50%, and the growth recovery was driven by a very sharp increase in exports. The region was quite lucky because after the crisis, the U.S. economy was very strong, and that helps to drive external demand and exports in the region. So most of the region were able to recover on the basis of very strong export growth to the EU. For Korea, you can see the growth also slowed from almost 9% to 5%, and then it slowed further to 2.8% after the global financial crisis. But what is remarkable about Korea was that in this period, most of the growth was driven by capital investment, whereas after the reform and restructuring of the chaebols, a lot of the growth in this period was driven by TFP growth. Productivity growth, and that's the reason why actually Korea was able to continue to rise up the value chain. So you can see the private investment, went up to very sharply, and then came down to about 26%. So it's a much lower level of investment, and the capital, the driver of growth shifted from capital accumulation to TFP growth. This is Malaysia, same story. You can see growth before the crisis was almost 10%, and it came to 5.5%, and then it slowed down further to 5.1%. And in the case of Malaysia, again, it's similar story. The growth was led by manufacturing exports, but Malaysia also benefited from a commodity boom around this time. And since then, the export has come down. But that's mostly because of the shift in final processing export to China, and most of the countries in the ASEAN region shifted to production of intermediate inputs that fed into the they were re-exported to China for final processing into consumer products. So this is Indonesia. Indonesia had a decline from 7.9%, almost 8% to 5.8%. So actually the decline wasn't less, but it took them longer to recover because of the political crisis they went through. There was, it took them a bit longer than the other countries to recover. But in any case, they did recover, and the growth was relatively strong, 5.8%. They also enjoyed a commodity boom at that time, which helped to drive the economy. And since then, growth has slowed somewhat to 5.1%. So what are the key lessons from the crisis? The key lesson that came out from the crisis is that they need to be wary of cross-border flows, especially capital flows. Joe Stiglitz had characterized the emerging markets as a small boat in an ocean of capital flows, which can easily capsize when there is a big wave. And I think that came through very clearly during the Asian financial crisis. And the lesson that I think the countries took from this was never to allow themselves to fall into crisis again, and the need to build self-insurance in order to build up greater resilience. So they took a number of measures in order to do that. After the Asian financial crisis, foreign borrowings were very closely monitored, and in many countries they require approval of the central bank before a corporate is able to borrow from abroad, or even the government. I think in some countries they need to get the central bank's approval. So they were very wary of borrowing in foreign currency, in US dollar particularly. And the other thing that happened is when there's a massive inflow of foreign capital, the central banks try to mop it up so that it doesn't put pressure on the exchange rate, because the exchange rate tend to overshoot because the forex market are relatively thin in most of this economy. So when there's a big flow either in or out, it tends to cause the exchange rate to overshoot. So many of them try to smooth out the volatility by intervening in the market, But to do that, then they need to build up a reserve. So typically what they'll do is, they'll intervene when there's a massive inflow, which leads to a build up in the reserve. And then when it reverses itself, they then, intervene on the other side to smooth out the outflow. So that has been basically the practice of most of the central bank in the region. Most of them find it difficult to allow the exchange rate to float simply because, as I mentioned, to avoid the excessive volatility and the overshooting of the exchange rate. Many of them are manufacturing exporters, and for them, the exchange rate is a key price for the exporters. And they came under a lot of pressure if the exchange rate, were to appreciate too much. So most of them have a managed float, and they try to maintain that, have more flexibility, but not too excessive. And they use the foreign exchange as a buffer to smooth out the shocks. But what it means is that the exchange rate, by becoming more flexible, means that they need an anchor. And so many of them move towards inflation targeting regime to provide the nominal anchor. So you can no longer fix the exchange rate, so they need more flexibility. So they then move towards a more disciplined monetary policy framework by targeting inflation. And that took place around, in the early 2000s, and has been relatively successful. As you will see, inflation rate has trended down across all the countries in the region and stabilized in the low 3%, 2 to 3% until recently. And at the same time, as I mentioned before the crisis, most of the government had relatively conservative fiscal policy. They had run small surpluses, but because of the crisis, and the need to bail out the corporate and the banks, they had, the debt spike up. So they were very mindful that they need to reconsolidate to build up and re-establish a fiscal discipline. At the same time, most of the countries reformed the regulatory framework to make it more responsive to the new financial landscape. They had to, introduce risk management to the banks, and at the same time, they established a higher CAR ratio and much more greater supervision of the banking sector. So they move away from just a regulatory compliance towards a more active supervisory approach to regulating the financial institution. So as a result of all the reforms that they took, growth recovered, as I said, as I mentioned, to about 5 to 6%. And they managed to repair the balance sheets of the corporate and restore the health of the corporate sector and the banking sector, and which then allowed financial intermediation to come back, and that helps the economy to recover. They deleveraged and they rebuilt the fiscal space, and also the exchange rate, I think I showed earlier, turned from a deficit to a surplus, and they were able to build up a quite significant foreign exchange reserve. So that's at the national level. At the regional level, I think many of the countries realize that they need to establish the regional liquidity facility in order to, as a buffer against the shocks. During the Asian financial crisis, most of the program were augmented by support from the neighboring countries, and this was mostly in the form of bilateral swaps between the central bank. So what they decided was to establish a network of bilateral swap between central bank, and that's what they call the Chiang Mai Initiative around 2000. Typically, these are bilateral swaps between Japan and the ASEAN countries, and also between basically the +3 countries and the ASEAN countries. And the bilateral swap is in the form of, in the case of Japan, US dollar swap against the local currency. Then after the global financial crisis, they decided to consolidate the bilateral swap into a multilateralize it, and set it up as a common facility for all the members, and they based on quota, depending on the contribution towards the facility. And the size of the CMIM at that time was 120 billion. This when it was set up in 2010. In 2014, they doubled the size of the facility, 240 billion. And they also introduced a new facility called the precautionary line of credit. So this is a preventive line of credit, similar to what in the IMF, the PLL and the FCL, which is a flexible line of credit from the IMF to the member countries, for those member countries that are strong performers, so that they have a line of credit from the IMF and they can draw down anytime they want. But they have to, in order to be eligible for that, they have to prove that they are sound and have strong fundamentals. So similarly, the CMIM, they set up a facility similar to that called the CMIM-PL. And this was to allow members to draw on the facility before they get hit by any shocks. At the same time, the linked portion of the facility used to be 10%. So that anything beyond 10% needs to have a program with the IMF. That portion was increased gradually over time to 40%. So now, for instance, if one of the big emerging markets, say Thailand or Philippines, wants to borrow from the CMIM-PL, they can borrow up to 40% without an IMF program. And that is about 11-12 billion US dollars. The total amount for each of the countries about $23 billion each. So those are the major ASEAN countries. Then for the smaller ones, the CMLV, the quota is smaller, and so the amount that they can borrow is also smaller. At the same time, because of moral hazard concern, they set up the economic review and policy dialogue process in order to conduct peer review of each other. I mean, they come to realize that you are linked to your neighbors, whether you like it or not, and if there's a problem in your neighbor, it could easily spill over to your economy. So the idea is to set up a review and policy dialogue process to make sure that the neighbors are disciplined in terms of that and following sound policies. So that was the genesis for the establishment of AMRO in 2011. In 2011, AMRO was set up as a regional surveillance arm for the CMIM to provide the analytical and policy support if there's a call on the CMIM, because this is to make sure that the member that's borrowing from the CMIM is sound and is able to repay the loan. The loans are relatively short term. They have to be 6 months and can be rolled over. But they are so for that reason, the creditor countries also want to make sure that the ones who are borrowing are following relatively sound policy. So AMRO was set up as the surveillance arm to provide that support to CMIM. And in February of 2016, AMRO was converted into an international organization. At the same time, the region also launched the Asian Bond Markets Initiative. There was a view at the time of the crisis that the region is too dependent on banking, borrowing, and they need to set up a bond market to provide a second pillar, so-called, in terms of financing for the economy. So that was set up back in 2003, and it's been very successful. The bond market development in the region, I think it's probably more advanced than most other developing countries. So this is a timeline of the regional financial cooperation. So, it basically traces the development of the CMIM initiative. As you can see, the crisis happened then. Then back in May 2000, the CMIM initiative was established. And then it became multilateralized in 2000, agreed to be multilateralized in 2007, but was actually set up only in 2010, with $120 billion after the global financial crisis. And then it was expanded to $240 billion in 2014. And recently, they amended the agreement, the CMIM agreement, to increase the dealing portion from 30 to 40%. And AMRO was set up in 2011 and became an international organization, in 2016. So this is the basically a chart of the bilateral swap between the members in the region, and most of the swap is basically between the +3 countries and the ASEAN countries, as you can see from here. I mean, I think this can go further back, but so in the case of Japan, the JMOV is the one which is the counterpart, and also BOJ to some for some of them. So this chart basically shows the what we call the global financial safety net. The first line of defense is the national reserve. When you get hit by a shock, you use your own reserve as as a buffer, either to intervene, to mitigate the shocks. And the second level is the CMI, the bilateral swap agreement that was set up under the CMI initiative. And then we have the regional safety net, the multilateralized CMI initiative. So this is a sort of a regional facility, that's available to the members. And finally, at the outer ring is the IMF resources. So in terms of access, you use your own reserve first, and then you draw on the regional safety net before you approach the IMF. So these are the amount, the size of the various facility. The IMF is the dark blue line here, and you can see that they are about the same size, each of them amounting to about $14 trillion in total. This is for the world, not just for the region. On the other hand, the first line of defense, which is the own reserve, that amounts to about $40 trillion now. The region, as you know, is one of the has one of the highest level reserve among all the other countries in the. Yeah, so that's at the regional level. At the international level, the AFC was also a shock to the international community, and they realized that they need to do something to, to strengthen the international monetary system, the surveillance framework, and the international financial architecture. So a series of reform were taken at that time. In the Financial Stability Forum and the G20 were set up in 1999, basically, because they recognized that the financial regulatory framework was relatively inadequate, and they need to be strengthened. So the Financial Stability Forum was set up to review the regulatory framework and make recommendation on how it can be improved. Similarly, for the G20 was set up at around the same time, because the US and G7 countries realized that a lot of the shocks were hitting developing countries, and it was affecting, their own financial institution as well. And so they need to bring in the big developing countries, to discuss policies and regulatory issues. So the G20 was set up at about the same time to facilitate, to be more inclusive, and to facilitate that policy dialogue and agree on policies that affect the global economy. And then during the global financial crisis, the Financial Stability Forum was elevated to become the Financial Stability Board. So initially it was set up at the deputies level, and so they decided to elevate it to the Financial Stability Board, and it was represented at the governance level. And it also was broadened to include all the G20 members as well. The G20, on the other hand, was elevated to a leaders summit because of the global financial crisis. They needed to, coordinate policies in order to support the global economy, which was so that was a time when, for the first time there was a coordinated fiscal pump priming, which helped to support the global economy and prevent it from crashing. The IMF also recognized that its surveillance framework has become inadequate, and they needed to reform the surveillance framework. And that was the time when they realized that they didn't fully understand the market, and the international capital markets was set up at that time. And they hired a lot of financial specialists in order to try to get a better handle on financial flows. The financial market has basically become a major player in terms of policy because of the volatility of capital flows. At the same time, they also introduced what they call the FSAP, the Financial Sector Assessment Process. And there are several modules to the FSAP. It's called ROS. Basically, these are best practices in terms of regulatory regime. So they have ROS for banking, for instance, the Basel Principle 1 and 2, and now it's 3. So what they do is, they will send peer regulators into a country to assess the regulatory regime in that particular country and see whether it's up to best international practice. So a lot of these reforms, were done in order to strengthen the robustness of the international financial system. There was also an issue with capital control, but this only came much later, because initially around the time of the crisis, they were actually moved to try to change the IMF charter to allow it, mandate to include authority over capital measures, capital control. But because of the Asian financial crisis, that that particular move didn't go through. But in any case, everyone realized that capital flows was a big issue, especially volatility of capital flows. And so in 2016, they finally came around to review, the policy on capital flows, and came up with a set of measures called the Capital Flow Measures Institutional View, on how and when capital flow measures can be taken and under what condition. I think the view from the region is still that it's still pretty timid. It doesn't go far enough to address the concern of the region, because the view is that you can introduce capital measures, but it has to be temporary and has to be withdrawn once the situation changes. So that was a problem, and it's still an ongoing issue for many countries in the region. So this is a timeline on the evolution of the FSF and G20. Started basically established in 2019, and as I mentioned earlier, and it's now elevated to G20 summit level, leaders level, and also the FSB. So basically, I've come to the end of my presentation. I thought I'd just talk a little bit about the new shock that took place because of the pandemic. I think the pandemic is a totally different type of crisis. It's not a financial crisis. It's a health crisis. But the measures that were taken to contain the crisis, was a shock to the system in terms of the finance, because it locked down the economy, it disrupted production, it disrupted income, and there's a liquidity crisis. And economies in the region had to, take very expansionary fiscal monetary measures in order to support the economy. So fortunately for the region, because of the reforms they've been implementing over the last 20 years, they were in a relatively good position when the crisis hit to support the economy. They were able to ramp up the fiscal policy, and also ease monetary policy, and regulatory measures in order to support the economy. And so in the last 2 years, despite the crisis, there's been no financial crisis in the region. And in fact, the external position strengthened in the last 2 years. There's been a build-up in the debt, especially in the public debt, the government debt, but also for some countries, the corporate and the household debt has increased. So the risk going forward is, how do you sort of exit from this highly expansionary stimulus package without causing the economy or supporting the economy in the recovery. And again, I think here the region is doing relatively well. So the measures that were taken back in to deal with this capital flow crisis have served the region well in terms of supporting the economy during the pandemic. But of course, going forward, we are now faced with new crises, new challenges, or new risks and challenges coming from the basically coming from climate change, maybe new pandemics, and the supply chain issues. And the question is whether we need to make further changes or reform to our monetary policy or policy and regulatory framework in order to deal with the new challenges. The new challenges like climate change actually requires collective action, unfortunately. And this is unfortunately a bit short at the moment. But I think these are new challenges that face the region, and within AMRO, we are now reviewing our facilities as well as our mandate in order to see how we can rise up to the new challenge, to meet the new challenges. So let me stop here.
Well, thank you so much, Dr. Khor. This was fascinating and interesting, and I I do apologize for not making the advertisement for the book ahead of your talk, but do realize that this book is also online as a PDF, so you can access it for free. And I encourage many people to read it because it is absolutely a fascinating account of an analytical account of what happened, but also a personal account of many of the players that were involved. Some of the players that were involved are actually online, and I'm sure some of them will call on you in due course. But let me start, and it's actually inspired by a question by Mr. Shu Satao. Do a little bit of, as they call it in the United States, Monday morning quarterbacking, because a lot has happened after the financial crisis, and by and large the region came out really well. But there still seems to be a lot of talk about what could have been done differently when the crisis happened. And talk about Thailand, the package for Thailand with massive reforms in the financial sector up front, all the closing of many of the finance companies, the famous or infamous structural conditionalities on Indonesia, when Suharto signed this letter of intent in January 1998, from a 25-year rear view mirror. Would you say that things could have gone differently if there would have been different treatment of that crisis?
Yes, I think it could have been different with the benefit of hindsight. But at the time of the crisis, the IMF, as I mentioned, did a bit of soul searching after the crisis, and realized that it was actually, inadequate in terms of the tools and the framework it had to deal with the crisis. So he applied the traditional medicine, which is to tighten your belt, tighten policy in order to, to try to defend the exchange rate, and turn the current account positive. This was applied, I think, in Latin America, but the crisis in Latin America was quite different because they were suffering mostly from a current account deficit crisis, whereas in the case of the Asian economy, much of the debt was by the corporate sector. As I mentioned, the fiscal account was relatively strong, positive. So applying that same medicine to Asian economy was definitely, improper or inappropriate, and I think that was realized subsequently. So as you can see from the COVID pandemic, right? The response was so different. I mean, immediately everyone recognized the need to take very expansionary fiscal and monetary policies to support the economy, right? Of course, there's a concern that exposed, you're going to have a problem because the debt is going to go up, and that may create and it has created a crisis for some countries. But because the region was relatively well positioned, it was able to do all this without suffering a crisis. So I think in retrospect, in the case of Thailand, at least, I think it could have been managed if they had the foresight and they deal with the financial distress in the banking, in the corporate sector, especially the finance company, the property company and all that, and try to get them to deleverage. I think it's possible that they could have had a smoother transition, but that was not the case, unfortunately. And because of the speculative attack, it triggered the herding behavior and a massive, sellout on the currency, and that makes the whole situation. So the dynamics of the whole thing was very different. And in the case of Indonesia, I think it was a political crisis, and that's not easy to foresee. But Indonesia was doing very well. If you look at the IMF report, in 1996, it was held up as a model economy. They were following. They had a sort of a crawling back system, and it was working very well until the crisis broke in Thailand, and then it came under attack. And after a while, they couldn't sustain it any meeting any longer and had to call in the IMF. So yeah, I think it was very painful, very traumatic, and maybe a bit of it was, it could have been handled better.
On that same theme, sorry to dwell, but there were two moments actually. There were during the annual meetings of the World Bank and the IMF in Hong Kong. There was a proposal already of an Asia Monetary Fund at that time, proposed by Japan. I mean, it was not formally proposed, but discussed, and that was heavily criticized.
Yes.
The second, and it would have been perfectly useful, frankly, at that time. The second was the controversy around capital controls. Indeed, the IMF 10 years after the fact came to a different position. You mentioned it, for many Asian countries, maybe not yet flexible enough. But I recall the enormous criticism that the Malaysian government came under after basically imposing capital controls because they had run out of reserves. Why were these two things so controversial at the time? Well,
in the case of the Asian Monetary Fund, we know that Mr. Yen, Sakakibara-san, came around. Actually, he came to Singapore and we met, when he made the proposal to set up the fund. And we were very supportive of that at the time. We thought it was a great idea. Because from their viewpoint and from our perspective, the region was doing very well. And we, in our view, it was mainly due to the speculators that, that triggered the attack. So it was a technical issue. It wasn't a fundamental issue, So we felt that a fund like this would be able to beat back the speculators. If it's big enough, you can defend the currency, and that would, help avoid a crisis. Unfortunately, I think the view of the US and the IMF was it was a moral hazard problem, that this would be something that countries with fundamental problem will use, because it's cheap money, it's easy quick disbursement, even when they have bigger problem. So because of that, the proposal was shot down and didn't take off. But as I mentioned, subsequently, what happened is, they set up this bilateral swap arrangement, and then over time multilateralize it. So if you take the AMRO together, CMIM is the equivalent of the Asian Monetary Fund that was proposed by Japan to some extent, but with conditionality as well. Now, under the new facility, the economy has to be prove that it's actually pursuing sound policy. So that addresses the moral hazard issue that was raised by the IMF and the US. On the second point, issue about the capital control, we know that the IMF was ready to propose a change in the mandate of the IMF in order to encourage countries to open up the capital account, right? So capital control was just the opposite of what they were about to do, and they were not convinced that it would help address the situation. And indeed, for some of the countries, it worked for Malaysia, as it turns out, because Malaysia had relatively strong administrative capability and regularity. But for some of the countries, even if they had adopted it, it probably would not have worked because it's very hard to implement a scheme like this of capital control. But the Malaysian did it, and they were quite successful in that, and it gave them the space they needed in order to repair the economy. Because of that, they are able to set the interest rate, and the big fight between the IMF and Malaysia was over the interest rate. How they wanted Malaysia to raise interest rate, and Malaysia know that if interest rate were to go up too high, it's going to kill the corporate sector. And so by imposing capital control, they are able to have an independent interest rate policy. So that, but I think in retrospect, the IMF also recognized that Malaysia has a point, and it's more flexible now. And not that the IMF would adopt capital control, but it's more understanding, and it's amending its institutional view to be more flexible on this.
During the time, actually, I mean, that's why I thought the Asia Monetary Fund, in a way, was in principle a good agreement. Not least because a lot of the regional policymakers did add on to the IMF packages. So there was, including Singapore, that gave money for, I believe, Thailand and Indonesia. So it would have been maybe a good arrangement. But anyway, in the end, we got the Chiang Mai initiative, and now we have that. But Dr. Kun Go has a question on that, and he says, is the region now really over-insured if you look at all these facilities and enormous amounts of international reserves? Has the reaction to the Asia financial crisis been an overreaction? Is there now too much international reserves? And mind you, they're not without their opportunity costs.
Well, in some countries are over-insured, I would say, yeah. And reserves are not cheap, so actually it's not been very cheap to build up self-insurance. But the nature of insurance is that you can get hit by a shock, which may never happen. And the more insurance you have, the less likely it is to happen, right? But the cost of building up the reserve and self-insurance is that you ended up with using a lot of your savings, which could have gone into investment in building up the reserve, right? And as a result, actually, some of the countries in the region, didn't invest enough in infrastructure, and that leads to a reduction in the growth rate. So there was a cost involved in terms of not just the cost of the investing in reserve, but a cost in terms of higher growth rate, potential growth rate, And I think some countries in the region are now trying to catch up. Indonesia, Philippines, for instance, in terms of trying to invest in infrastructure to build up the capacity for growth. So yeah, so as long as we have this floating exchange rate system with the US dollar as a dominant, you're going to have this wave of financial cycle which can hit the emerging markets. I mean, it just happened when the US Fed raised interest rate, but it didn't hit the region that badly because the region was strong. So the speculators or investors know that the fundamentals are strong. But this is the kind of shock that we're going to continue to have to manage as long as the international monetary system is anchored around the US dollar and floating exchange rates.
Yeah, some would like to see that differently, but we might come to that. Dr. Anthony Quek, who used to be at the ADB at the time, has a comment on that, and I'll just paraphrase the comment. He basically said, look, yes, there was lots of the flexible exchange rate system after the collapse of the Bretton Woods was there, but of course, the regional currencies or the Asia financial crisis basically happened because those countries had not adjusted their currency system. They had not gone to a float. Yes, there was a managed float, and in Indonesia, a fairly flexible one. But in the end, it was opening up capital account channels, not fully open, but capital account channels, combined with a fixed exchange rate that led to probably a vulnerability that could not be managed in the prevailing system. And I think that's a fair comment at this point. The question, there's two questions from Dr. Chen Gang and Clarence Lee, basically the same type of question, but now that we are in 2022, we see another major turn in monetary policy happening, especially in the United States. The EU is still talking about it because they have some other problems on their hands. But before the Asia financial crisis, there was the Mexican financial crisis, which was basically triggered by a major change in monetary policy in the United States. And the knock-on effect was that a lot of capital flowed to Asia and then came back and stopped. Now, today, for the region, but also for the world, there's another adjustment in this monetary policy. With a strong dollar, a lot of debt is still in dollars for emerging markets. Are we again at risk for another round of crisis to happen?
I would say not. And the reason is, if you look at the interest rate in the region, especially the long end, it has gone up because the US rate has gone up and it's sort of pulled everything up. But it went down quite significantly before that. So now it's reverting back to where it was before the crisis. But more important, I think, is that as I mentioned, the external position has actually strengthened in the last 2 years, and many of them have accumulated reserve. And so they are in a much stronger position to buffer the shocks than before. The debt has gone up, but much of the debt in the region is domestic currency debt. Because of the collapse in domestic demand, financial savings went up very sharply. And so a lot of the fiscal deficit has been financed by drawing on financial savings, domestic financial savings, rather than external borrowing. So some of the countries were concerned that they might, because of the risk aversion, that there will be capital outflow, and they issue global bonds in foreign currency. And most of that borrowed funds ended up as a reserve in the central bank. So that's why the central bank accumulated more reserve on top of the current account surplus that they, which also lead to the accumulation of surplus, especially in the case of the Philippines. The surplus the current account went from a deficit to a big surplus, and on top of that, they had a lot of these global bonds that added to the reserve. So I think the risk is quite small, in my view, that there will be another big shock in the region. And for the other countries in the region, like Thailand, they're just swimming in reserve. So there's really no risk of balance payment crisis at all.
You noted the success of the establishment of the regional bond market, or the local bond market, the local currency bond markets, I should say.
Yeah.
At the same time, I think we have become aware of increased risk even there, because for some countries, there's a large share of the bonds are being bought by foreigners who might still sell and might still put pressure on the currency. How do you see that risk at the current stage in East Asia?
Yeah, that was a concern or disappointment that many of the policymakers have, because they were told that if they were to develop a domestic currency bond market, right, you give them greater protection against what they call the original sin problem, which is a mismatch in currency, right? But as it turns out, if the foreign investors were to buy a local currency bond and sell, they want to withdraw the money in foreign exchange, right? So it comes back to hit them, and didn't really go away. And we saw that during the taper tantrum, So if the foreign holdings of your local currency bond is high, then you are actually vulnerable to this shock of an outflow, right? But as it turns out, at the moment, in the last 2 years, the foreign currency holding of local currency bond has gone down, partly because when the crisis first hit in 2020, there was a big outflow, and then there were very little inflows after that. So relative to the total stock of debt, which a lot of the increase was from domestic investors, the share of the foreign currency has gone down quite significantly, and relative to the increase in the reserve holding is much smaller now. So because of that, I think that the region is much more resilient to these kind of shocks.
There's one potential cause of the Asia financial crisis that you haven't discussed yet, and it was discussed at the time. And I'd like to put the question because it might be relevant for today. That was namely the depreciation of the yen, the Japanese yen, in the mid-90s. And the thinking was that actually there was increased competition from Japan. And mind you, China also had depreciated in 1994 quite drastically with its unification of the exchange rate. The thinking was that had knock-on effects on the export performance of the Southeast Asian countries. And as in reaction, there has been more, basically the policy reaction was let in more capital to have more domestically led growth. Now we again see quite a bit of changes in the relative exchange rates. The yen is again very weak, but also the RMB has been weakening over time. Is that a risk for the region, or have things changed so much that it's no longer relevant? And also, what was your thinking on this potential cause of the financial crisis?
No, as you mentioned, the RMB depreciated very sharply in '94, right? Because of the very high inflation, and there was a big black market. The RMB went to over 10 RMB per dollar, and then they subsequently stabilized at 8.6. And since then it's been appreciating. So when the crisis hit, it was around 8.6, I think, or that level, 8.2. Okay, it was already depreciated from where it was in 1993 and 94. And they decided to hold it then. I think that was very helpful, but I think that in terms of valuation, the renminbi was relatively competitive already, and there was no reason for the central bank to depreciate it further. So it was very helpful. If they depreciated, it would have probably caused a bit of a concern in the region. And in the case of the yen was under tremendous pressure at that time, went down to 140 something. But as I mentioned, I think that the attack on the local currency, right, was triggered not because of what happened outside the region, but what happened within the region, and it was triggered by the hedge funds circulated attack on the Thai baht. Okay. And so I think regardless of where the yen was, it would have happened because they saw vulnerabilities in Thailand because of the massive borrowing from abroad. They have the BIBF window, to borrow short term and lend to the developers. So I think that would have happened. What I think was different was that because of the problem with the yen, right? There was a massive withdrawal of Japanese funds from the region after the crisis happened. Okay, and that I think was not helpful in a sense in terms of the recovery of the region. So that was when I think a lot of the banks from Europe came in. So there was a sort of a shift in terms of funding from Japan to Europe and the US. Although after the global financial crisis, it reverses again. The European basically pulled back very sharply from the region, and the Japanese came in. So there's this flow of funds at the international level, but I think it didn't really affect the crisis in the sense that I don't think it was a trigger. It may not have been very helpful in terms of the recovery of the region. And now, of course, we have something in a way similar because the yen is under pressure, and that's mostly because of the yield curve control, and it's very technical because the US dollar, the gap, the spread between US dollar interest rate and Japanese has been widening, and that's pushing down the yen. But again, I think the driver for most of the currency in the region is the US dollar and not so much the yen. The yen will, of course, a lot of people expected that the yen would benefit from safe current haven flow, and that has not happened. And on balance, I think it's still open question whether the weaker yen is a plus or negative for the Japanese. I mean, traditionally, it's been a weak yen. It's been good for the Japanese economy. But I think the views are changing, and people are thinking that a very weak yen actually leads to high inflation and higher costs, which cannot be passed on because of the deflationary environment, and therefore it's been a drag on the economy rather than a boost.
All right. Well, thank you so much, Dr. Khor. This was a very interesting lecture, very fascinating topic, and I thank you for your frank and open answers in the discussion. I thank everybody for coming to the lecture. We had a wonderful attendance of over 130 people, and most of you stayed. That is always my quality indicator. So thank you so much for spending some time with us in our East Asian Distinguished Lecture today. Once again, Dr. Khor, thank you so much, and goodbye to everybody.
Thank you, Bert. And once again, just to mention that the book is available for download from our website, so feel free to do it.
Please do. It's a fascinating read. I can recommend it to everybody in this Zoom because everybody is interested in that topic. So thank you all very much.
Thank you, Bert.